Today we're looking at financial instruments, and we'll be looking at financial instruments over the next couple of months. So today it is part one, an introductory session on financial instruments, and then next month we'll look at a few more interesting things, which will also include hedging. So for today, a fairly soft introduction to financial instruments, a bit of an overview. A roadmap for this session. We'll look at an overview of financial instruments and a few recent developments. Then we'll start by looking at identification or definitions of financial instruments and specifically financial assets, financial liabilities. In the third session, or the third section, we look at categories of financial instruments. Now, that section is the most important part of today. It's all about putting financial instruments in the correct categories, because the categories would determine, the accounting treatment, and that would be the recognition, the measurement, etc. So section 3 really important. And when often I get asked questions around financial instruments or I'm reviewing financial statements, the issues are usually around the categories. And interesting, AASB 7 or internationally IFRS 7 actually requires us to disclose the categories of financial instruments in financial statements. And that's something that I hardly ever see in financial statements. So we need a little table with the categories of financial instruments and a list of which of our financial instruments belong in which category. So that's an interesting disclosure that I think is often overlooked. And then in section 4 we move on to recognition and measurement. So that's the roadmap for today, and this is the first part. Next week we look at a little bit of hedging, we look at some convertible notes, some compound financial instruments, and really step it up. Sorry, not next week, next month. So an overview, I thought let's get in a helicopter and have a big picture overview of the financial instruments accounting standards. These standards are definitely not as beautiful as Sydney Harbour, but I think this question to me really illustrates the importance of an overview of a big picture. I often go to Sydney, or used to often go for Sydney for work, and I have to tell you, I get so lost in Sydney. I get out of the building, I don't know left, right, I have no idea. And usually I'm quite good with direction. But as soon as you see the big picture on where Darling Harbour is, where the bridge is, where Opera House is, suddenly you find your space. So I think overview is important to set the scene for financial instruments. So if we look at the current accounting standards, at the moment we've got 3. So we've got AASB 139, which is looking at recognition and measurement. Internationally IAS 39 and New Zealand IAS 39. Then we also have another one, AASB 132, looking at presentation. Now the bit that often gets me confused is the definition of financial instruments, and the categories of financial instruments are in AASB 132. But when you want to see the recognition and the measurement, you have to go to 139. And if you then want to know how to present it in financial statements, you are back in AASB 132. And then if you want to do the disclosures, you go on to IFRS 7, AASB 7, which internationally is IFRS 7 of New Zealand, IFRS 7. So really with financial instruments, currently we are in and out of these standards to determine the accounting treatment. If you look at the future accounting standard, is AASB 9, financial instruments. So it's a one-stop shop for everything to do with financial instruments. This has been the most interesting standard I've seen in a long time. It's been issued in pieces, the first time I've ever seen that. Over a number of years, they've slowly been issuing parts to AASB 9. And very recently, at the end of last year, the final part have been issued, and that was around hedging and impairment. So finally, we have the whole of AASB 9 at our disposal, but they are giving us some time to get ready. So the mandatory effective date for applying the new AASB 9 is annual periods beginning on or after 1 January 2018, and this is for Australia. And then for most entities in Australia, that would mean 30 June 2019. So it's another 3-4 years that we have to deal with whatever we've got on this slide, the current accounting standards, the mix, the whole mixed bag of AASB 139, 132, and AASB 7. Before we look into the details, often people would say, we don't have an accounting policy note about financial instruments because we don't have financial instruments, or our client don't have financial instruments. So I thought before we look at the details, because some people might look at this webinar and say, oh, she's talking about financial instruments, who care, we don't have financial instruments. So let's just clarify, which entities have financial instruments? And the answer is all entities, each and every one. It would be really an exceptional situation when an entity would not have financial instruments. And the why? Let's look at some operational activities and consider your entity or your client's entities. We provide customers with credit terms, and those credit terms would result in the recognition of trade receivables. So whether we provide a service or whether we sell goods, it doesn't matter what the kind of arrangement is, as soon as we provide credit terms. So as soon as we're in a situation where sales or services are not cash sales and services, then we've got trade receivables, and that's a financial instrument. So these days, show me a set of financial statements or show me an entity where they don't have trade receivables. Other reason is, what about investing activities? Often entities, if they've got, or in the fortunate position, they've got excess cash generated from operations, they would invest them. They won't just sit with the cash. They'd say, we want the cash to work for us. So it could be in corporate bonds or other investment strategies, whether it's shares, whatever. So often those investment strategies end up in financial instruments. The other one, or the other reason, is funding activities. So a company borrows money from banks to fund capital expenditure. As soon as we do that, that liability with the bank, or that loan that we have to repay to the bank, or the loan to share, the loan received from shareholders or loan received from a parent entity, any of those are financial instruments. And then also, as part of our risk management activities, we could enter into foreign exchange contracts. So we are importing or exporting. Those contracts are in US dollar. We are preparing financial statements in Aussie dollar. We want to manage our risk around those foreign exchange, potential foreign exchange movements. We enter into a foreign exchange contract, and that would be a derivative, and all derivatives are financial instruments. So if we think at this, and we look at the activities highlighted on this slide, list an entity, a client that don't have debtors, don't have cash, don't have investments, don't have loans. And remember, cash and cash equivalents would also be a financial instrument if you look at the definition. All right. So let's move on. So we've said in section 1, we currently have 3 accounting standards dealing with financial instruments. They are quite complex, and the interrelationship between them are complex. And we have been applying them since 2005, so we should be quite comfortable with them by now. For the next 3-4 years, that's what we've got. We are waiting to implement AASB 9. It is available for early adoption, but you have to be careful and to make sure you understand all the consequences. So this is what we're dealing with, and we're saying all of our entities, all of our clients have financial instruments. So this is really an important area. So every set of financial statements that we pick up, there should be an accounting policy note 1 on financial instruments. In every set of financial statements, there should be a note on the categories of financial instruments as a minimum, absolute minimum. So if we go on to section 2 and we look at identification or the definitions that we find, and most of these definitions are actually in AASB 132, although the title says presentation. Now let's start with the definition of a financial instrument. Now a financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or an equity instrument of another entity. So if we look at that definition, we would say there are two key elements to that definition of a financial instrument. The one is there must be an agreement between two or more parties, so we need a contract between two or more parties, and this agreement must give rise to a financial instrument for both parties. So the one party has an asset, the other party has a liability or equity. So those are the two key elements. So let's look at an example. So let's say once a customer has bought inventory on credit, a trade payable or a financial liability is raised in the buyer's records. So the buyer would say, debit my inventory, credit trade payable, so it's a financial liability. The seller would say debit trade receivable, a financial asset, and credit sales. So the buyer has a financial liability, the seller has a financial asset. Further, when we look at these sales, it's a contract between the buyer and the seller. So the seller's got certain obligations to deliver the goods and the buyer has obligations to pay for those goods. So it establishes rights to receive cash, so the seller would receive cash and the buyer has an obligation to pay cash. So this is a typical financial instrument. If we look at a number of examples, we could ask, are the following financial instruments? And I've listed a number of examples, and we'll test it against the definition. So the first one is cash at bank. The second one is trade receivables and payables. The third one is prepaid expenses. The fourth one is deferred revenue. The fifth one, loans or bonds or notes or convertible notes. I've got investments in listed company shares. I've got intangible assets, and I've got a current tax receivable. So I will give you a minute or two to, next to each one of them, just make a tick, yes, it's a financial instrument. So whether it's a financial asset or liability doesn't really matter. Is it a financial instrument, yes or no? And if no, why not? So if you go back to our definition, the two criteria, do we have a contract and do we have an asset and a liability? So I'll give you a minute or two to go through that list. I'm still here, don't worry, I'm just staying silent so you can tick which of those are financial instruments and which are not. I'll give you a tip. 4 of them are financial instruments and 4 of them are not. All right, I hope everybody's done. Unfortunately, I can't see you, so I don't know. All right, let's move on. So I've said the financial instruments are cash at bank, and what's my reasoning behind that? Cash at bank represents a contractual right of the depositor to obtain cash or to draw a check or make an electronic fund transfer from the bank. So it's a financial asset. And there's a corresponding financial liability on the bank. If you go to the bank and you want your money, they have to give it to you. So the fact when I deposit money into my bank account or a bank account or an investment account, there's a contract between the two of us. So cash at bank is a financial instrument. So again, a lot of people say, but my client or my client or my entity don't have a financial instrument, but you've got cash. All right, trade receivables and payables. This would be a financial instrument. It gives rise to a financial asset representing a contractual right to receive cash in the futures. Payables, on the other hand, it's a liability, which is a contractual obligation to deliver cash in the future. If we go on to loans, which is a financial instrument, so whether you're the holder of the instrument or whether you're the issuer of an instrument, so you either have a right to receive cash or you have an obligation to pay cash. So that's easy. What about an investment in listed company shares? So listed company shares is a financial asset of the holder. So there's a right to future cash flow in the forms of dividends. And remember, on the other side, we've got equity instruments of the issuer. And if you go back to that definition, as soon as we've got a financial asset in the one entity, the other entity either has a financial liability or equity. And that's what we've got here. If I've got an asset, I've got shares in an entity, and I've got a right to receive dividends, etc. in future, the other side is not a liability, and there's no obligation on the entity to pay a dividend. They'll only declare a dividend if they've got profits, etc. But it is an equity instrument. And then if we look at the items that are not a financial instrument, the first one is prepaid expenses. Now, prepaid expenses are assets for which the future economic benefit is the receipt of goods or services. So if I've prepaid certain expenses, in future, I'm going to receive goods or services. It's not a right to receive cash in future, and therefore it's not a financial asset. Now, this is generally speaking. If you've got a prepaid expense, and in terms of your contract, you have paid, let's say, to lease a building for the next year, and however, if for one or another reason you cancel the lease or you move out of the premises and they're going to repay that money to you, which is hardly ever the case, you could say it's a prepaid expense where I'm not only going to receive the use of the building, I might have a right to receive the cash back. But in general, prepaid expenses would give you a future economic benefit in the form of you're going to receive goods or you're going to receive a service, and therefore it's not a financial instrument. So a similar argument applies to deferred revenue. Deferred revenue are not financial liabilities because the outflow of economic benefits is the delivery of goods or the delivery of services rather than the outflow of cash or another financial asset. So usually deferred revenue, I've received the cash before the end of the year, but in the next year I have to deliver goods or I have to deliver a service. So that deferred revenue doesn't give rise to an obligation to an outflow of cash. What about intangible assets? So control of an intangible asset creates an opportunity to generate an inflow of cash or other financial assets, but it does not give rise to a right to receive cash or another financial asset. So intangible assets, property, plant and equipment, inventory, all of them are in a similar position. All of them are giving you an opportunity to generate an inflow of cash or another financial asset in the future, but it doesn't give you a right to receive cash or another financial asset. The last one there is a current tax receivable. Current tax receivable, we would say it's not an agreement. It's legislation. So we don't have a choice. So tax receivables are also not a financial instrument because it's in terms of legislation. So the first thing is always to determine, do we have a financial instrument, yes or no? And if we have a financial instrument, we have to go and look at the standard and say, what would the standard say about this financial instrument? So the first step is to identify our financial instrument. The other thing that's really important, and I haven't gone into too much detail today, is once we've got a financial instrument and we consider applying AASB 132, 139, AASB 7, each one of those standards start off by saying that this standard shall be applied by all entities to all types of financial instruments except for. And then each one of them have certain exceptions specifically listed. Now the exceptions usually relate to transactions that are covered in other accounting standards that's maybe more relevant. So for instance, they would say AASB 132 shall be applied by all entities to all types of financial instruments except for financial instruments, contracts and obligations under share-based payment transactions, to which AASB 2 share-based payments applies. And then they go on except for. So the scoping around financial instruments is quite an issue. So you might have a financial instrument, but when you look at the scope paragraphs, you might be scoped out of the financial instrument standard, and as soon as you're scoped out, it would push you to another standard to deal with the situation. So let's move on to financial assets. Now, financial asset is any asset that is cash, an equity instrument of another entity, or a contractual right to receive cash or another financial asset from another entity, or exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. We also look at it's any asset that is a contract that will or may be settled in the entity's own equity instruments, and then it goes on to talk about whether it's a non-derivative or a derivative. Now, I'll come back to this part of the definition very shortly. If you look at financial liabilities, it says any liability that is a contractual obligation to deliver cash or another financial asset to another entity, or to a contractual obligation to exchange financial instruments under potentially unfavorable conditions. An asset is we exchange and there's favorable conditions. A liability we exchange and it's unfavorable conditions. So I'm thinking about derivatives here. And then it also goes on to have a similar requirement, but obviously the opposite, to a financial asset, and that is a contract that will or may be settled in the entity's own equity instruments. So we are going to settle by issuing shares in the entity, and it is a non-derivative for which the entity is or may be obliged to deliver a variable number of the entity's own equity instruments, or a derivative that will or may be settled other than by, and that's in bold for a specific reason, other than by the exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. So in that part, that other than, as soon as we've got the fixed for fixed criteria, we would say fixed for fixed, and it would be equity. So it's a financial liability other than if we meet the fixed for fixed criteria. Therefore, fixed for fixed criteria, we've got equity. I hate it when they write the standards with double negatives. It does my head in because English is not my first language. These double negatives, you find it in financial instrument standards a lot, and also in AASB 112 around income taxes. So I thought, let's move into, what is that fixed for fixed? And I want to give you two situations to contrast. And now in the first situation, I've said, let's say entity A issued a convertible note or a convertible loan to entity B. So entity A would say debit cash, and the question is, what would be credit? Usually, or in the old days, we would say credit the loan. But in this instance, we want to determine, is it debit cash credit loan, or is it debit cash credit equity, right? Or is it a compound? So how do we do that? So I'm trying to work through the situation and see what is that credit. So let's say the convertible note is a $100 convertible note. And entity B has the choice whether to convert this convertible note into shares in entity A or not. So let's say it's a convertible note, it's convertible in 5 years' time, and entity B, so the note holder, has the option to decide whether they want the cash from entity A or whether they want shares in entity A. Now that's an important statement, bullet point 3, because if the choice was with entity A, then this would not be a financial liability, because entity A would have a choice whether they want to pay cash or whether they want to issue shares. Therefore, there's no obligation to deliver cash, therefore it's equity. However, if the choice is now with entity B, we have to analyze a little bit more. So let's say in terms of this convertible note, if converted into shares, entity A will issue as many shares as needed. So it will be a variable number of shares to settle this convertible note. So what do I mean by that? If at conversion date one share in A equals $1, then entity A will issue 100 shares to settle this convertible note or loan. However, if at conversion date one share in A equals $2, then entity A will issue 50 shares to settle the convertible note or loan. So if you think of the situation, entity A will issue as many shares as needed to settle a debt of $100. If you look at entity B, they will either receive $100 or they'll receive shares in entity A that's worth $100. So your note holder, entity B, is not taking equity type risk. They're taking a debt risk. And therefore this convertible note would be a financial liability in the records of A. Right? Because we don't have this fixed for fixed criteria, it's a variable number of shares. Contrast that to situation 2, where entity A issued a convertible note or a loan to entity B. Again, the convertible note is $100. Entity B has a choice whether to convert the note into shares or not. Where it changes is the bottom part, the last 3 bullet points. If converted, entity A will issue 100 shares in entity A to settle the convertible note. So it's a fixed number of shares that will be issued by entity A. Now, if at conversion date one share in A is worth $1, then entity A will issue 100 shares to settle the convertible note or loan of $100. However, if at conversion date one share in A is worth $2, then entity A will still issue 100 shares. So what we're saying is it doesn't really matter what the value of the shares are at conversion date. Entity A has fixed that they'll issue 100 shares to settle the convertible note of $100, irrespective of what the fair value of these shares are at conversion date. Therefore, in this situation, the convertible note is equity. it meets the fixed for fixed criteria to be equity. If you look at the note holder side, the note holder will only ever receive $100 or 100 shares in entity A. So the 100 shares could be it could be worth 1 cent each or $10 each. Therefore, entity B, the note holder, is exposed to a risk that is similar to equity risk, or a risk that an owner in the business would take. Therefore, if you look at the two situations I've described, the key thing is consider whether this instrument or contract exposes the holder or the issuer to the risk of movements in the fair value of that issuer's equity. So what does that mean? If the holder, in our examples, entity B, is at risk to the same degree as equity investors in the entity, it is likely, not always, it is just likely that the instrument or contract should be classified as equity. So we are saying the risk that the note holder is taking is that they could get $100 back, or they could get 100 shares back. And those 100 shares could be worth $1 million, or they could be worth 10 cents. So they're taking a risk that's similar to the risk that any investor in the entity would take. And therefore, we've got equity. Right, so really important to consider this fixed for fixed. There's often a lot of sensitivity and misunderstanding around fixed for fixed. So hopefully that clarifies it. The other thing that we should talk about up front is derivatives. Now, derivatives have all three the following characteristics. So the fair value of a derivative change in a response to a change in an underlying, either an interest rate or security price. So that's a price on the stock exchange, a commodity price, for instance, gold or iron ore, a foreign exchange rate, a credit rating, or some other index. Usually with a derivative, there's no or little initial investment, and that's what makes derivatives quite risky, because you could enter into a swap or a future without spending money, but then in 3 months' time when the thing settles, you could be out of pocket quite significantly. And then it is settled at a future date. So on day one, there's no initial investment or limited initial investment. There's limited cash outflow. You take on a huge risk, so you could make a lot of money or you could lose a lot of money. So that's what a derivative is. And in the old days, before we had all these financial instrument standards, people would enter into these derivatives, and because there were no or limited cash transaction initially, this huge risk or this huge potential for upside or huge risk for downside was never reflected in historical cost financial statements. So a derivative is something that is now included in the standards, that's specifically included in the balance sheet at reporting date. Derivatives are always at fair value with changes through profit and loss. The only exception to that is if we've met all the requirements to apply hedge accounting as defined in AASB 139. Examples of derivatives: forwards, swaps, options, futures. So a swap where you swap a fixed interest rate to a variable interest rate or vice versa. A forward contract, the best example is a foreign exchange contract. So as soon as your entity have a foreign exchange contract, we have to say, oops, we've got a derivative. Do we apply for hedge accounting in terms of AASB 139? And to meet the criteria is very difficult. So usually those derivatives would be in the balance sheet at fair value. And depending on whether the underlying exchange rate moved in your favor or against you, it would be a financial asset or a financial liability in the statement of financial position or your balance sheet. So let's move on to section 3, categories of financial instruments. Now this is the key part because it drives recognition, measurement, potential reclassification or not, usually the or not disclosures, etc. So if you look at the categories of financial instruments, first of all, we've got financial assets, obviously, or financial liabilities. Financial assets, we've got 4 categories. So it could be fair value through profit or loss. It could be loans and receivables. It could be held to maturity, or it could be available for sale. And I'll say up front, available for sale is a rubbish name, and it's no longer in AASB 9. It's a confusing name. If you've got shares that is held for trading, it's not available for sale. Right? Note that. If you've got shares and it's held for trading, it's not in the available for sale category. It's actually in fair value through profit and loss. So there's a lot of confusion around that. And then when you look at financial liabilities, a lot easier. There's only 2 categories. It's either fair value through profit and loss, or it's other. So that's an overview of the categories we have at our disposal. So let's work through them systematically. If we start with financial assets and we start with fair value through profit and loss, we've got 2 subcategories. Or this is really, how do you become fair value through profit and loss? It's either because it's held for trading. So held for trading, it's acquired for selling or repurchasing in the near term, or it's part of a portfolio where evidence of short-term profit taking, or it's a derivative that's not designated as a hedge. So as soon as you've got a derivative which is not designated as a hedge and doesn't meet the hedge accounting requirements, it can only be one category. Whether it's an asset or a liability, it is fair value through profit and loss. All derivatives, fair value through profit and loss. So the one way to become fair value through profit and loss, if it's held for trading, the other way, it can be designated on initial recognition to be fair value through profit and loss. And that designation option is open because in their hearts of hearts, the accounting standard setters would like financial instruments to be at fair value through profit and loss. They don't think the world is ready for that. So they give us other categories to keep us happy in the meantime. However, you know, if you really feel like it, you could designate your financial asset or liability to fair value through profit and loss. That option is open, but it's on initial recognition. So you cannot move in and out of fair value through profit and loss as you see fit. So the year that you're making a loss, you say it's not fair value through profit and loss, and then when the year you make a profit, you say, oh, no, it's fair value through profit and loss. So be careful. So what does fair value through profit and loss mean? Exactly that. These financial assets would always be at fair value in the statement of financial position, always fair value. And changes in fair value from one reporting period to a next reporting period will be reflected in profit and loss in your statement of comprehensive income. So if an item is in this category, fair value through profit and loss, it could potentially lead to volatility in your profit and loss or the old income statement. If we move on to the next one, financial assets that are held to maturity, HTM, it would be non-derivative financial assets because derivative financial assets are fair value through profit and loss. So it's non-derivative financial assets with fixed or determinable payments. It has a fixed maturity, and the entity has the positive intention and ability to hold it to maturity. So examples would be a 5-year bond repayable in 5 years with a 9% annual coupon, or, so really important that these items usually, they can be traded. Because they've got fixed and determinable payments, there's a fixed maturity. Although it's our intention to hold them and it's an ability to hold them to maturity, the other part that's important is that these are items that if you wanted to get rid of them, you could quite easily sell them to somebody else they take over your asset, for example. So held to maturity is you've got the intention to hold it to maturity. So shares in BHP Billiton don't have a fixed maturity or fixed and determinable payments. You know, there's no, if you've got shares in BHP Billiton, there's no criteria that you have to sell your, or, you know, it's not if you have to sell it at a certain stage. There's no that you're going to receive certain payments. You can't say I'm definitely going to receive certain dividends, etc. So that's not held to maturity. The other one is to look at loans and receivables. So it's a non-derivative financial asset. It's got fixed or determinable payments, and it's not quoted in an active market. So I want to go back to the previous one. Held to maturity is quoted in an active market. You can sell it, you can get rid of it. So it's quoted in an active market. And it's got a fixed maturity. And you can't be quoted in an active market if you don't have a fixed maturity. If you go to loans and receivable, there are fixed and determinable payments. So we know what our debtors are going to pay us. We know what our loan receivables are worth. And it's fixed or determinable. We know what the interest rate is, etc. It's not quoted in an active market. There's not, we'll say, we don't have a fixed maturity. I mean, we would like our debtors to pay us as soon as possible. However, and so an example would be trade and other receivables, and it would be cash and cash equivalents. If we go on to available for sale, and I just call it AFS because available for sale is just too nasty. And I want to repeat this. If you've got shares that's held for trading or any financial asset held for trading, it's not in this category. It's in the category fair value for profit and loss. So really, AFS is the bucket. As soon as you've got a financial instrument, you would see, does a financial asset, you would say, does this financial asset fit as a loan and receivable? No. Is it held to maturity? No. Is it fair value through profit and loss? No. Or do I want to designate it as fair value through profit and loss? No. So if you answer no to all of the above, it would be an AFS. It's the bucket at the end. Examples of AFS would be investment in shares, which are not held for trading. So it would be investment in shares in subsidiaries, associate joint ventures, or joint arrangements which we keep for a longer time. So as soon as you've got investments in the financial assets, it's not held for trading. It's not designated as, it's not designated as fair value through profit and loss. Doesn't meet the criteria that it's fixed and determinable in loans and receivables and held to maturity. This is how you get here. So the categories of financial instruments, this slide is just a little bit of a summary to say, you know, how do we put it on one page the different categories. So it's a repeat of the previous slide on fair value through profit and loss, loans and receivables, held to maturity and available for sale. So remember, we're looking at the categories, and these are the categories. We've looked at the 4 financial assets. Let's now move on and look at the financial liabilities. Financial liabilities, only 2 categories. It's either fair value through profit or loss, or it's other financial liabilities. Now, other financial liabilities is the, you know, if it's not fair value through profit and loss, it can only be other. And all financial liabilities, or all other financial liabilities, are recognized at amortized cost. So you could say all financial liabilities are recognized at amortized cost except for financial liabilities at fair value through profit and loss. So financial liabilities are fairly easy. You know, the normal principles, they're all at amortized cost. Unless you met the criteria for fair value through profit and loss, or you designated it at fair value through profit and loss on day 1. So what are the subcategories again? So the same subcategories that we had for financial assets would apply to financial liabilities. Is it held for trading, or is it designated on initial recognition? And remember, derivatives will always be fair value through profit and loss unless it's held in a hedging transaction and it meets the requirements for hedge accounting in AASB 139. So again, this is a slide pulling together the categories of financial instruments and looking at financial liabilities. All right, so let's move on to recognition and measurement. So it's taken us a long time to get to recognition and measurement, but this is the process. You have to determine, do you have a financial instrument? Then you have to determine this financial instrument, is it within the scope of the financial instrument standards? You have to look at AASB 132, 139, AASB 7. Then you have to determine in which category do they fit, and only then do you get to recognition, which is the debit and the credit, or the measurement, which is how do we measure it initially and subsequently. So if you look at initial measurement, because that's really the big deal, you know, the journal is never hard. It's the, you know, the recognition is not hard, it's the measurement. Now measurement, most accounting standards talk about either initial measurement or subsequent measurement. So they'll say initial measurement of an item is as follows, and then subsequent measurement is something different. As an example, if you look at property, plant and equipment, there's initial measurement of property, plant and equipment at cost price in AASB 116. And then subsequent measurement, it's an accounting policy choice, whether you want to keep it at cost or revalued amount. So this whole thing between initial measurement, which is day one or the date of the transaction, versus subsequent measurement, which is reporting dates or balance sheet dates going forward. So in your head, it's important to differentiate between, is it initial measurement day one, or is it subsequent measurement, all future reporting dates, balance sheet dates. So if you look at initial measurement is at fair value, plus or minus, and it depends on whether it's a financial asset or a financial liability, plus or minus transaction costs on initial recognition. And that's a general principle, but you know, the standard, there's always a general principle and then there's an exception. The exception is we would always exclude transaction costs if the financial instrument is classified as fair value through profit or loss. So if you've got a financial asset that's in the category fair value through profit and loss, on initial recognition, transaction cost has to be expensed. End of story. Or if you've got a financial liability that on day one you've got transaction costs, those transaction costs have to be expensed. So these are the general rules of at fair value plus or minus transaction costs, and it applies to all categories of financial assets and financial liabilities except for financial instruments that's at fair value through profit and loss. So can you see already the category of the financial instrument determines the initial measurement. So subsequent measurement, this is where the categories become even more important. Because if you look at, and I've put on one slide, financial assets and financial liabilities, if we start on the top one, if you've got assets held at fair value through profit and loss, or it could be the second last one, liabilities held at fair value through profit and loss, their subsequent measurement is at fair value. Whether it's an asset or a liability, it's always at fair value, subsequently in the balance sheet, always at fair value. And what do we do with changes between one reporting date to the next reporting date? It goes to profit and loss. If we look at the second instrument there, which is the financial asset, loans and receivables, we know initially it's fair value plus or minus transaction cost, but subsequent measurement is something called amortized cost. And the value change is not really relevant unless it's impaired. And we'll look at an example of amortized cost very soon. If it's held to maturity investment, HTM, it's amortized cost. And if it's all other liabilities, it's amortized cost. The one that I want to come back to is number 4. It's the only one we've skipped, and that is available for sale or AFS assets. AFS assets are in the balance sheet at fair value. The difference is that the changes in fair value would go to equity or in other comprehensive income. So it goes to equity, it ends up in equity, but in the statement of comprehensive income, it would go to other comprehensive income. So that is subsequent measurement. So remember we said measurement has initial measurement and subsequent measurement, and then when we look at subsequent measurement, there's actually only two options. The financial asset or financial liability based on the categories are either at amortized cost or it's at fair value. When you look at the fair value alternative, they can either be at fair value through profit and loss, or they could be at fair value through equity, which is AFS. So where do we get that fair value from? And you get the fair value from AASB 13 or IFRS 13, which talks about fair value measurement. Now in the old days, all of that fair value measurement was included in AASB 139, and now it is in a separate standard, AASB 13. So fair value, that is a separate discussion. I want to focus on the specific concept that we've got here, which is amortized cost. So what is amortized cost? Now it's the amount as measured at initial recognition. So what is that initial recognition? It's fair value plus transaction cost, less any subsequent principal and interest repayments, plus your accrued interest, using the effective interest rate method, less any reductions for impairment. So amortized cost, we start with the amount at initial recognition, and we make adjustments for repayments. We include accrued interest, and you don't straight line accrued interest. You have to use the effective interest rate method, and you have to consider impairment if it's a financial asset. So that slide can change into the following. We could say it is the amount measured at initial recognition, less the principal and interest repayments since initial recognition. We can add the interest that's accrued. So this is not the interest that's paid, it's the interest accrued using an effective interest rate method. It's not a straight lining. And then the last one is to consider impairment if it is a financial asset. So this is amortized cost. So often people would say, okay, I know I've got a financial liability, it's another financial liability, it has to be at amortized cost, which means I have to use the effective interest rate method. So what does it mean? So the amortized cost method amortizes any fees, cash flows paid or received, transaction cost, other premiums or discounts included in the calculation of the effective interest rate over the expected life of the instrument. And the question, in all of these slides comes back to what is effective interest rate method. So what I've said, the effective interest rate, or you would call it the internal rate of return, IRR, is the rate that exactly discounts estimated future cash payments or receipts through the expected life of that financial instrument. So if you look at a timeline, which I've got here, year one or year zero is day one. What's the cash flow day one? What's the cash flow at the end of year one? What's the cash flow at the end of year two? Your effective interest rate is the rate that would discount all those cash flows, the future cash flows, back to the net cash flow on day one. So if we work out, in this example, ABC took out a loan maturing in 2 years for $100. Fees for establishing the loan is $1. Now that fee for establishing the loan, please note, when you pay that fee, you don't expense it. That fee comes into this timeline and forms part of your effective interest rate calculation and becomes part of amortized cost. So if we say on day one, our cash inflow is debit cash of 100 because we get a loan and credit loan 100. But then we also have to pay fees for establishing the loan. So we would say credit cash, and we would not say debit expense, we would say debit the loan. Then we would say, what would the cash outflows be in future? We're going to pay $15 at the end of year 1 because it's a 15% interest rate. That's the cash flow. At the end of year 2, we're going to pay another interest of $15 and we're going to repay the loan of $100. So what we do in Excel, and we use the IRR function, we say year 0, there's a cash inflow of 99. There's a cash outflow in year 1, end of year 1, minus 15. And the end of year 2, there's an outflow of minus 115. So if you now say, put in the formula equal IRR B2 to B4, you highlight your cash flows, it would come up with an interest rate, and that's your effective interest rate of 16%. So you will now use that 16% to prepare an amortization table. And you use that amortization table to create your journal entries. So I wanted to show you in Excel how we come up with the effective interest rate. In my next example, we move on to the journal entries. So in this example, we said Entity A takes out a loan maturing in 5 years for $1,000, and let's say that already includes the transaction costs. The principal amount to be repaid in 5 years is 1250. The interest is payable annually at 4.7%. So the actual cash payment is based on the 4.7% on the 1250. We're going to pay $59 per annum at the end of the year. And now we have to calculate the effective interest rate. So you're going to say day 1 is a cash inflow of 1,000. At the end of year 1, there's an outflow of 59. End of year 2, outflow 59. End of year 3, outflow 59. End of year 4, outflow 59. End of year 5, outflow of 1,309. Right, so you have to work out the net cash flow at each date, put it in Excel, and determine your effective interest rate, which is 10% for this example. You can go and check it. Next step, so first step is do a timeline of our cash flows. The second step is to say we now need to do an amortization table. So our opening balance of our loan is 1,000. The interest, and remember our effective interest rate is 10%. So you apply the 10% on the opening balance of 1,000. I'll just get my mouse. So the interest is using the effective interest rate that you've calculated, the 10%. 10% of the opening balance is 100, so that increases your loan. You deduct the cash that you've paid out, the 59, and that is the closing balance of your loan at the end of year 1, which becomes the opening balance for year 2. Your interest is the 10% that we've calculated on the opening balance, which increases the loan. Credit, the loan is decreased with the actual cash outflow, the interest that we pay, and we've got a closing balance. And this all builds up slowly over time, and then the cash flow at the end of year 5 is the 1,309, and the closing balance is 0. So if you do your timeline correctly, if you calculate your internal rate of return or your effective interest rate correctly, your amortization table at the end of the life should come back to 0. Now we use this table to do the journal entries. So the journal entries would be for year 1, would be debit the interest expense. I'll just go back. We will say if we've got the interest, it's debit the interest expense. Debit the interest expense, and you can do it the long way or the short way. You could say debit the interest expense, credit the loan. And then you would say credit cash, debit the loan with 59, or you could do it net where you say debit interest expense in profit and loss 100, credit cash the outflow of 59, and credit the loan of 41. Because during year 1, the difference between the opening balance of the loan and the closing balance of the loan is there's an increase in that loan balance of 41. And you keep on doing that in year 2, in year 3, in year 4, in year 5. So every year you'll have an interest expense, and the interest expense would be the interest expense per your amortization table. Your cash flow will always just be the 59, and therefore your loan builds up slowly. And at the end of the period, you've got the cash outflow of 1,250, and you debit the loan, and it's all back to zero. So that's your journal entries using amortized costs. I just want to come back to amortized costs. Therefore, if you've got a loan in your books that's accounted for at amortized cost, I have to see an interest expense in your profit and loss based on effective interest rate. And transaction cost on those loans, because it's amortized cost, should not be expensed when you incur the transaction cost. It should be capitalized into this amortization method and amortized cost calculation. Example 3 is where we look at a situation where entity A acquires a financial asset for $1,000. It's an AFS asset, which has to be measured at fair value. There's a purchase commission of $2. The fair value, or the quoted market price at the next reporting date, is $1,000. And there's a sales commission cost of $3. So what is the value on initial recognition and subsequent recognition? Now initially, because it's AFS, we would say initial recognition is fair value of $1,000 plus the transaction cost of $2. So initial recognition is $1,002. Then when you go on at the first reporting date and at every future reporting date, your fair value, your recognition is fair value, and your fair value is your quoted market price of $1,000. So sales commission costs are not deducted from fair value. Fair value is fair value. So on initial recognition, we've got it at $1,002, and subsequently, the first reporting period, it's $1,000. So if we think of this one, what would the journal be? On initial recognition, we would say debit investment in shares, $1,002, credit cash, $1,002. At the end of the year, subsequent measurement of this financial asset is fair value. So we have to say credit that investment with 2 because it has to be at fair value of $1,000. What do we debit? Because it's a financial asset, it's AFS, we debit the equity reserve, AFS revaluation reserve. And we'll talk about potential impairment, etc. at the next webinar. However, with an AFS, the first entry goes to the AFS revaluation reserve, and then we assess if it's a negative reserve, whether it's impaired or not. Example 4, it's again an AFS financial asset. 1,000 shares are purchased on the 20th of August for $50 each. There was additional brokerage transaction cost of $1,000. They did not intend to sell the shares. It means it's AFS. At 30 June, which is at the end of that year, the price of the shares was $55, so there was an increase. And then the 21st of September, we sold the shares. So what would the journals be? So it's AFS. So initial recognition on 20 August is the cost price, and we capitalize the transaction cost of $1,000. So it's debit investment in shares, $51,000, credit cash, $51,000. At 30 June, it should be at fair value. Fair value is $55 a share, so it should be at $55. So we debit investment in shares with the additional $4,000, and we credit an AFS reserve with $4,000. So it goes through other comprehensive income, not through profit and loss. And then in the next year, when you sell the shares, the way I do it, I first revalue the shares at the date of sale. So I debit investment in shares with $7,000, and I credit my AFS reserve, because at the previous reporting date, it was in the records at $55,000. We now know fair value is $62, so we debit investment to get it up to $62. We credit the reserve with $7,000. We then get rid of these shares, so we credit investment in shares with $62, and we debit cash, the cash proceeds, and now we've got a problem. We no longer have the shares, but in our statement of changes in equity, we're sitting with an equity reserve of $11,000, and this $11,000 can now be transferred to profit and loss. So you know, when we look at AASB 101 and we look at items in other comprehensive income that in future could be reclassified or not reclassified, recycled, yeah, reclassified to profit and loss. AFS is one of them. So at the date of sale, once this is realized, we say debit that equity reserve. The equity reserve should be zero, and we credit profit on sale of shares.